Hello and welcome to this special presentation powered by NSE and brought to you by CNBC TV 18. National Stock Exchange, of course, is the largest exchange in India and for the last 2 years, the largest derivatives exchange globally based on the number of contracts traded and commemorating the contribution made by the founder of the National Stock Exchange in transforming the landscape of India's capital markets. We are here to honor late Dr. R.H. Patil through an exchange of thoughts and insights on the market economy and behavior as part of the Dr. R.H. Patil Memorial Dialogue 2021. I'd like to invite Mr. Vikram Limay, MD and CEO of the National Stock Exchange, now to deliver his inaugural address. Over to you.
Thank you. Ladies and gentlemen, a very warm welcome to all of you. The annual Dr. R.H. Patil Memorial event features thought leaders of the highest caliber and reputation to serve as a fitting tribute to the memory of our founding Managing Director, Dr. R.H. Patil, who was a stalwart and an institution builder of the Indian financial services industry. NSE, under the leadership of Dr. Patil, played an instrumental role in setting up the first depository and the first clearing corporation. These were critical market infrastructure institutions that addressed pertinent issues of bad delivery, fraudulent and duplicate certificates, and established trust in the markets. NSE owes a deep sense of gratitude to the vision and missionary zeal of Dr. Patil, the founding team, past and present employees, SEBI, and the government for laying the foundation for critical market infrastructure institutions responsible for the robust growth of our economy and capital markets over the past 2 decades. In a relatively short period of time, NSE has emerged as not only the largest exchange in India, but also amongst the top 3 or 4 exchanges in the world. It is also the largest derivatives exchange in the world for the last 2 years in terms of the number of contracts traded. As an institution of national importance, NSE plays a critical role in working with regulators, government and market participants in the development of capital markets. The last 18 months have been extremely challenging for all global economies. As India is emerging from the pandemic, the pace of economic activity is showing signs of improvement with a decline in overall infection rate, phased reopening of the economy, and vital policy support from the government and central bank. Recovery in global demand has also aided India's external sector. While inflation is a concern, the IMF has projected India's real GDP to grow at 9.5% in 2021 and 8.5% in 2022. Equity markets saw their best performance in a decade last year, thanks to several supportive factors, including coordinated fiscal and monetary policies, several initiatives taken by SEBI, vaccine availability, and emerging demand recovery in the developed markets. Leading equity benchmark indices, including the Nifty 50, have touched all-time highs. Strong foreign institutional flows and direct investments have led to forex reserves reaching record levels. NSE witnessed more than 17 million new investor registrations in the last 2 years, of which more than 8.6 million investors were in this fiscal year alone. We are committed to building trust and integrity in financial markets by investing in technologies and regulatory initiatives that reinforce risk management, streamline compliance requirements, and protect investor interests. From a policy and regulatory standpoint, it is important to build trust and demonstrate stability to give confidence to investors. Compliance requirements need to be further streamlined to make it easier for people to invest in Indian markets. Product innovation and simplicity are also critical to further penetrate and intermediate retail savings into markets. We collaborate and co-create unique solutions that are delivered through an amalgamation of our years of experience, market insight, and a keen understanding of emerging technologies. Our environmental policy articulates our commitment, actions, and strategic intention in the area of sustainable development. The cornerstones of NSE's approach to enhancing its economic impact encompass measures to ingrain good corporate governance practices, disciplined market development, efficacy in market transactions, and stimulating market inclusion. This is vital to fulfilling our vision of catalyzing India's transition from a banking-based financing model to a capital market-based financing model, bolstered by innovative, market-driven products and deep and broad financial markets. Like last year, this year's Dr. R.H. Patil Memorial event is also being conducted virtually and will be in a discussion format. We are indeed very fortunate, grateful, and honored to have with us Dr. Lawrence Summers, former Treasury Secretary, Presidential Advisor, and President Emeritus at Harvard University. In conversation with Dr. Summers, we have Dr. Surjit Bhalla, eminent economist, author and columnist, and currently the Executive Director for India at the International Monetary Fund. I'm sure we will all gain valuable insights from the discussion today, and I would like to thank all of you for attending this event. Thank you very much.
Thank you very much, Mr. Limay. Indeed, we are looking forward to that exchange of thoughts and ideas. It's time now to present the highlight of this special presentation, a conversation, as Mr. Limay said, between Dr. Lawrence H. Summers and Dr. Surjit Bhalla, two distinguished individuals. Dr. Summers, of course, is the former U.S. Treasury Secretary, Presidential Advisor, and President Emeritus at Harvard University, and he's also considered to be one of the most brilliant economists of his generation. Dr. Bhalla is an eminent economist, author, and columnist who is currently the Executive Director for India at the International Monetary Fund. This indeed promises to be a very engaging talk spanning the impact on financial markets from geopolitical and economic factors, market efficiency, inflation, ESG, flow of funds, and cryptocurrency. So without further delay, it's over to you, Dr. Bhalla, for your conversation with Dr. Summers.
Thank you very much. And I would like to thank the National Stock Exchange and you, Larry, for this opportunity to discuss the world and the Indian economy. We all have just experienced 2 years of the pandemic. And as we speak, world leaders are discussing what to do about climate change. 45 odd minutes is too short a time period to discuss a rich set of questions. And you have been a leading expert and spokesperson on many of the issues confronting the global economy. In the interest of time, let me first fast forward to the first question, which is, what has the last 2 years experience with the pandemic and lockdowns forced you and us to rethink about the global economy?
Surjit, let me say that I'm very grateful to be in dialogue with you. You are an old friend from whom I've learned a great deal. One of the highlights of my visit to India as Secretary of the Treasury was the opportunity to visit the stock exchange. I have very good memories of that visit, and I think all who are gathered here who recognize the importance of well-functioning capital markets in all those many dimensions are part of something hugely important. None of our economies are going to grow and function well without well-functioning and stable financial markets. Surjit, I think I've learned 2 or 3 things from the experience of the last few years. First, I've learned something about global interconnection and consequent global vulnerability. We are all part of one world. Viruses anywhere can become viruses everywhere very quickly. None of us are safe, really, in a world where mutation is possible until all of us are safe. And so whenever I thought about the importance of finding global strategies for collective action before, the gravity of the COVID crisis has certainly led me to see that as a more important issue going forward than I did before. Second, I think we have learned from what has happened that just in time is very, very important, but just in case is as well. And so I think that in economic planning for households, for companies, for nations, issues of resilience are likely to loom larger going forward than they have in the past. I think the last thing we have learned, and maybe this is a lesson we've learned more in the United States than elsewhere, is that there are those who believe that inflation was a historical phenomenon, and that now that we have globalized technology and independent central banks, inflation is not a threat that needs any longer to be of concern. And I think anyone who thought that after the events of the last 6 months in the industrialized world has to stop thinking it. So I would say common humanity and global system, importance of resilience, and risks of inflation being real are the three main lessons of the COVID period so far.
Let me get to the inflation part immediately, which is what is concerning all of us and in the world. And as you know, there's talk of 70s style, high inflation, low growth, stagflation, etc., coming back into play. Now, what we have seen over the last 20 years or 25 years, that inflation has systematically come down across the world. And median emerging market inflation in 2019 was just about 1.5 percentage points below advanced country inflation. Now, can this be reversed just by, so what has changed so structurally? I can see the temporary phenomena of high inflation, but what has changed that we'll get a sustained high inflation?
I don't know, Surjit, that we will get a sustained inflation, and I am closest to the data and the phenomena in the United States. In the United States, it seems to me that we are now running an economy that is close to its post-COVID potential. If you look at goods production, we're actually running well above the pre-COVID trend. If you look at services, we're running below. On average, it about averages out. So by the end of the year, we're going to be pretty close to our potential level of GDP. And yet we have interest rates at epically low levels. Real interest rates for the next year are likely to be -3% or more negative than that. Fiscal policy is highly expansionary. Financial conditions reflecting equity market developments and tight credit spreads are extremely loose. So I don't think it should be surprising that you would see rising inflation. On top of that, you have a set of structural changes in the labor market that have in all likelihood operated to produce more expansionary pressures, and you're seeing wage inflation really take off in the numbers. So I don't think that these things are about deep changes in structure. I think they're about the orientation of policy. And when you run an economy with interest rates well below the neutral interest rate and unemployment well below the neutral unemployment rate, and fiscal policy well more expansionary than normal, it shouldn't be surprising that you get a tendency towards rising inflation. I think it's now clear, as you have Economist magazine covers about shortages of everything from eggs at the supermarket to psychotherapists are now in short supply. Everything from tennis rackets to airplane seats are now in short supply. That when you start to see pervasive shortage, that's a sign that demand is running very hot relative to supply, and that's a sign that you should be concerned about inflation. I think that we in the United States are making a serious error in being insufficiently concerned about inflation, and that is likely to lead to an overheating of our economy, perhaps followed by policies that prove to be contractionary in a not entirely controlled way, perhaps followed by a financial accident of some sort. But it means it's hard to be extremely optimistic.
Let me just pursue that a little bit. In the beginning, one of the big lessons, not that we didn't know about it or you didn't know about it, but about the global interconnectedness and about true globalization being here. Now, one of the effects of globalization is that educated manpower, woman power, human power, can be easily done without changing location. So, and one statistic I'd like to offer is that in 1996, there were 50 million college graduates coming out of the Western world, and about the same coming out of the developing world. Now, there are 60 million graduates coming out of the advanced countries and 250 plus coming out of the developing countries. Where is this human capital going to go? And why would it push up wages when you can hire people? Again, I completely buy the argument that we've got a short-term problem, but maybe a year from now that we'll have high inflation. Wages have to go up around the world in order for that to happen. And there is a lot of human capital, very good labor available at quite low rates. So it's the resurgence of high inflation perhaps a year from now by high I mean 3 to 4% in the Western world and 6-7% in the developing world, just to give broad ideas of magnitude.
Surjit, I think one of the continuing consequences of COVID is that just as we are having this dialogue virtually, a much larger fraction of my life takes place on Zoom than used to be the case. Ultimately, that is, I think, likely to be a substantial positive for economies like India's, because as businesses realize that they can carry on business not in place, but virtually, the idea is going to come very quickly that it doesn't really matter whether I'm 20 minutes away from headquarters at my home or 10,000 miles away in India. And so I think that the opportunities for skilled labor from traditionally low-wage societies to challenge traditionally high-wage labor in high-wage societies are likely to be very real. And that greater globalization is potentially a counterpoint to the inflation that I'm describing. I think so far, however, the inflationary threats in the United States have probably come more from labor that cannot be outsourced at the low end. Waiters in restaurants, for example, people who give haircuts, massage therapists, house cleaners. And to the extent that that is true, you don't have an antidote from what's going to happen from abroad. I think the considerations involving greater threats from abroad, while you adduced one very powerful one, there are also going to be likely to be more restrictions on immigration going forward than there were in the past. That operates in the other direction. And of course, this emphasis on resilience and just in case as well as just in time, I think also operates to suggest shorter supply chains.
Final word on the inflation before we shift to other subjects. As you know, the Fed has been talking about lower for longer. And there are recent Fed papers suggesting that the role of inflation expectations determining inflation have been exaggerated. And related to that, the policy of inflation targeting, which many countries have followed, do you think there is perhaps the days of and the importance and the relevance of inflation targeting central banks are over?
I think that would be too strong a statement, Surjit. I think that inflation is I think inflation targeting was always a somewhat exaggerated idea. I never was one who felt that hinging policy on whether inflation was running at 1.7% or 2.3% was a particularly good idea. I think the most successful bit of financial communication in the last 40 years was Bob Rubin's innovation of saying a strong dollar was in our national interest in the 1990s in the US, and then declining to be drawn out in any way on what he meant by a strong dollar or what about strength in other currencies. He would just repeat, a strong dollar is in our national interest. I think that was more effective, credibility enhancing financial communication than much of the complexity associated with current central bank frameworks. In a way, the Delphic oracles understood something that central bankers today have lost the thread on. The Delphi oracles understood that if people think that you are omniscient and omnipotent, but actually you're not, you're better off keeping your statements vague and oracular. And that was something that central bankers in an earlier era, as they focused on price stability as a dominant goal, used to emphasize. Today, as we have various mechanisms of reporting and dot plots and detailed forecasting, I feel as if it may do more to diminish the credibility of central banks by demystifying what's going on and demonstrating their inevitable ignorance than it does to contribute to greater confidence in the path of policy. But I do think that central banks also need to be very careful about what has become a growing tendency to become woke and to hold themselves out as solutions to problems for which their monetary policy tools are ill-suited. Problems like social deprivation and inequality, problems like excessive production of carbon dioxide, problems like lack of legitimacy of governments. And so I would rather see central bankers more narrowly focus their attentions on business cycle stabilization and the maintenance of financial stability, along with the avoidance of inflation, with less specifics and less broad gauge ambition.
You know, about a decade ago, you talked about secular stagnation and how there was a need for greater fiscal deficits to finance growth. Have you changed your mind on that, or in terms of your forecast now, we're shifting gradually to the growth side? And I'll bring in carbon in a minute, but what are the prospects for growth, both in the advanced countries and in the developing countries, given
Surjit, I expressed the concern
of some inflation, but more importantly, after the pandemic, what is your assessment for growth?
Surjit, I expressed the concern in late 2013 that the industrial world had an excess of saving relative to investment. That chronic excess of saving was likely to lead to a situation where real interest rates were very low, where because of limited investment opportunities, savings were likely to flow into existing assets, creating the possibility of substantial financial instability, and where growth was likely to be relatively sluggish, along with limited inflation. The situation was likely to bear some resemblance to the late 1930s. I think those judgments proved out. If one looks at growth after 2013, fiscal policy was more expansionary than people expected at that time. Monetary policy was much more expansionary than people expected at that time. And yet, nominal GDP growth, real growth, and inflation were much lower than people expected at that time, exactly as you would expect if you were encountering a problem of savings absorption and chronic excess saving. The fact that the United States fought World War II did not make Alvin Hansen's theory of secular stagnation wrong. It meant that economic conditions had drastically changed, that the savings investment gap in favor of savings that he saw had been reversed by massive government spending. That's what I see having happened this year as the GDP deficit, as the deficit approached 15% of GDP. So at present, when the vacancy rate in the American economy is greater than it's ever been since they started keeping the statistics, it would certainly be wrong to say we have a secular stagnation phenomenon. I think there's room for very substantial debate about where the economy will settle in 2025 or 2026 after we get through the current set of challenges. What is striking to me is that if you look at the market or you look at the consensus forecasts, they are forecasting remarkably low levels of interest rates. And even with those remarkably low levels of interest rates, relatively modest growth rates, and little tendency for the economy to overinflate. And so what's priced into markets is something very much like a substantial decline in the neutral interest rate. That may well be right. I'm not so sure, though. I think it's also possible that people are over-extrapolating from the recent experience, that neutral interest rates are rather higher than people believe, and that we're going to get some rather substantial surprises over the next couple of years in the level of interest rates and in the level of asset prices. Certainly, it would be my judgment that prudent emerging markets will be making plans for the possibility of a quite different global economic environment in which interest rates in the United States and perhaps in Europe as well have increased by several hundred basis points.
So one inference of what you're saying, and I think you'll be broadly right. Look, we are likely to see higher growth in the future, somewhat higher inflation, tempered by perhaps not that much of a long run. But, you know, there is, as you know, and you've talked a lot about this, a lot of resources being devoted towards climate mitigation and what that means for different economies, especially like India, that we would like to achieve a somewhat higher income level, higher growth. So how do you think this trade-off is going to play out in the developing economies like India and in the US? Because if you devote more towards taxation and carbon mitigation, growth is likely to go down. So how are we going to get inflation, as well as what I think is more likely, as you think, I think, that growth is going to come back in some way. So how do you play this trade-off with carbon policies?
I find myself with kind of an intermediate view. There are some, certainly many in Glasgow, who speak in a way that suggests that if climate change were not a problem, it would be a good idea to pretend that it was, because it was going to create so many economic opportunities for green energy that it would actually be a boom to economic growth. I don't believe that. I believe that when you have more constraints, you achieve less good outcomes. And an economy constrained to not do things that produce excessive carbon is going to be an economy that's going to perform less well than an economy that didn't have that constraint. It's going to be a better economy because we're going to avoid a set of consequences of climate change. But I do believe that there is a cost to dealing with climate. That seems to me to just be economic common sense. On the other hand, I do think it is a bearable cost. And given the stakes involved for the planet, given the stakes involved for many countries, given the stakes involved particularly for low-lying coastal areas in the developing world, I don't think there's a realistic alternative, but serious policies directed at long-run decarbonization. I might add that that includes not just stopping and slowing the growth of carbon emissions, but also will ultimately require finding ways to take carbon out of the air, perhaps relying on solar power to generate hydrogen as a tool of storage, and perhaps as a fuel tool as well. So I think on net, this is likely to be a substantially costly undertaking. There will be winners and there will be losers. The ultimate benefit will come in terms of preserving the planet. But I think to somehow suggest, as many do, that even apart from preserving the planet, this is going to create more good jobs and therefore be beneficial to the economy, I don't think that's terribly likely.
Just to pursue the entire question of climate change, and as I mentioned earlier, there's Glasgow happening, COP26 happening. The world reached a certain agreement in 2015 in terms of the Paris Agreement, where there would be allocation of funds to the developing countries for fighting climate change. And the target was given as something like by this time, $100 billion will be transferred for the global effort, because this is a global public good. It's only been about 15, 20 billion. So to what extent do you think the world will be able to reach an agreement now for the world together to fight climate change, rather than as like the pandemic, like the virus, if you don't control climate everywhere or carbon emissions everywhere, you're not controlling it anywhere. So how is the world going to be more successful now, given its experience with the pandemic?
I am of two minds. On the one hand, I think if you had told me 4 years ago that there was going to be a pandemic and that it was going to have the kind of parameters that COVID has had, and that 18 months into that pandemic, 1 billion Indians would be vaccinated with new vaccines that had been developed since the pandemic for a new strain of coronavirus, I would have been very pleasantly surprised to hear that that was true. And every time I despair of the global system's capacity for cooperation, I remind myself of that remarkable event in India. Above all, it's a tribute to the Indian democracy, but it's a tribute also to the global community in which it is embedded. So I think that excessive pessimism is a mistake. That said, I would say that the difficulty in moving forward aggressively on relatively limited measures that would be sufficient to substantially increase the world's pandemic preparation is unfortunate. That I'm grateful to see communique language, but the firmness of commitment to new arrangements of governance and new funding is something we're still going to be working towards. And I think so far, it does not look like there are going to be the kind of far-reaching commitments in Glasgow that would be necessary for it to be seen as a historic turning point with respect to mankind's efforts to contain climate change. On the other hand, I am reminded of what is said that Winston Churchill said about the United States, that the United States always does the right thing, but only after exhausting all the alternatives. And there's some of that about the global system. And so my guess is that there will be less sacrificing and more progress with respect to global climate change than most people now think, because I think technology will continue to surprise on the high side in terms of what it is able to do with respect to climate.
You know, there was not so long ago, we were arguing for high fiscal deficits, high investment, and therefore high fiscal deficits in the US. And when the pandemic happened, I think you as a Democrat, and as well as all the Democrats, wanted a large infrastructure package. Two things have happened. That infrastructure package has been substantially reduced. And second, and related to that, and a similar problem that economies or democracies, more importantly, like yours and ours face, is bringing about reforms, much needed reforms. Do you think democracies pay a cost, or you think eventually the rule of law prevails, democracy prevails, and we all end up doing the right thing?
I think that's the proposition that's going to be tested in the next quarter century. I have always been a strong believer in democracy. I have believed that the frustrations that come with democracies moving slowly because of checks and balances and the need to reach consensus, that those challenges are much smaller than the challenges of lurching autocracies. I believe that that was the great lesson of the 20th century, the catastrophes of Stalinism, the catastrophes of Maoism, and that ultimately government by the people is most likely to be government for the people. But I believe that proposition is going to be tested in the years ahead. It's going to be tested by how well in the United States we do in meeting our various challenges of moving a society cohesively forward. I believe it's tested in India, where the question of India's ability at a moment when, given all the intellectual capacity that exists in India, given the advantages of rule of law, English speaking, facility with information technology, India should be able to grow at 8 or 10% a year over the next generation. India has a set of fundamentals that should enable it to grow more rapidly than China, given its lower starting point. But will India be able to? I think that's something that many, many people are going to watch and is going to contribute to this century's verdict on democracy as a way of organizing human society. So I think there are very great stakes in the success of what we do in our country and what you do in yours.
You know, when the pandemic hit, and as you know, there's an old saying, old line, never waste an economic crisis. We had a big crisis in the world, and India was one of the very few countries that took advantage of bringing about fundamental structural reforms in the economy. Now, one would have expected a lot more countries, developing countries, to bring about reforms. That didn't happen. So I do agree with you that the future for India looks very good, precisely because we have brought about major structural reforms. Why didn't it happen? I mean, this is the perfect time. We all said crisis comes about, bring about reforms. Or you think there's a real problem in bringing about reforms, much needed reforms in a democracy?
Yeah, I think change in democracies is always hard. And you have to remind yourself when you're frustrated by the slowness of change that often you can make change that is more deep when it is allowed to bubble up rather than when it is imposed top down. I think you're reminded that not all change is good, and that the various checks and balances associated with democracy often can contribute to a kind of Hippocratic oath where you avoid taking uncertain steps that are harmful. I think for many countries, the simple tasks of socially isolating people, getting jabs into arms, maintaining a healthcare system at a time when there's a flood of demand were sufficiently overwhelming that thinking about other policy preoccupations was difficult. And so I think it's the nature of the emergency that in some ways it concentrated the mind on a particular set of areas, and that may have contributed to its being more, making it more difficult to generate reform in many areas.
You know, of all the problems in the world and successes in the world, looking into the crystal ball, what worries you most about the future of the world economy, advanced economies, as well as India? What would be high on your list of
I think I
you really have to worry about this?
I think there are two things I worry about primarily. I worry about our success in managing the global commons, which is much more important to our security than it ever has been before. I think the prospect is that there will be another COVID, quite likely a worse variant, that will come within the next 10 to 20 years. Will we be more ready than we were this time? That's one thing I worry about. Will we meet the challenge of global climate change before nonlinearities start to have devastating and divisive effects around the world? Will we, as we inevitably become more integrated in a cyber sense, become desperately vulnerable to cyber attacks of various sorts that can be launched by state actors or by non-state actors? Will we have a system that adequately protects the global commons? That's one thing I worry about. The other thing I worry about is, will we successfully accommodate China's efforts to define its greatness and its strength over the next several decades? There is no serious question that the changes in China's economy are the biggest thing that has happened in global economic history. Think about it. The Industrial Revolution was a few tens of millions of people managing to grow their economy at a rate where standards of living were 1.5 times as high at the end of a human lifespan as before. What's happening in China is the development of a capacity to generate growth at levels where living standards might be 100 times as great at the end of a human lifespan as they were at its beginning. That doesn't happen without a society redefining its aspirations, without it redefining its global role. Certainly as Britain came of age economically, certainly as the United States came of age economically, we redefined our concept of our relations with the rest of the world. And so how will this rise of China be managed? And what will the consequences be for the global system? That is, I think, the second profound challenge we face. And it is hard not to be more worried about that than one was 2 or 3 years ago, as one sees the growing sense of truculence between China and the rest of the world, and between the rest of the world and China. So those are the two things that most keep me up at night.
You know, to conclude, I have one last question. And since this is the National Stock Exchange, listeners, etc., many people around the world are interested in where financial markets are going. And we've talked about the economic fundamentals. And the markets have really rallied around the world, especially in India. You think there's a disconnect in the emerging fundamentals of the world economy and where financial markets, they're supposed to forecast growth, etc., 6 months from now, a year from now, 2 years from now. So you think there is a disconnect, or maybe the financial markets have got it right?
I can certainly envision scenarios where what is valued into financial markets pans out, where interest rates remain low and cash flows remain relatively strong. On the other hand, I have learned over time that the way to judge a market is less to ask how you feel about its level than to ask, can you construct credible scenarios where it's a third above its current value? Can you construct current scenarios where it's a third below its current value? And I confess I find it easier to do the latter than I do to do the former. That is, I see more room on the downside than I see on the upside. And in that sense, I think markets are pretty fully valued. History suggests that there is substantial vulnerability of emerging markets to significant increases in U.S. interest rates, and that rising inflation in the United States is eventually met by rising interest rates. And so I think there is a quite difficult issue there.
Okay, last on this, and the last keeps getting further and further, but you have said that the reforms and the prospects for India are growing at 10%, and let us say on a sustained basis. I think one forecast, which is more conservative than yours, is India growing at 8% and finally emerging as a leader in world growth, much like China was 10, 15, 20 years ago, and China's growth is on the way down. Now, given and the fact that we've introduced significant reforms, and there is prospects for even more reforms. Privatization is no longer a four-letter word in India. It's actually happened. So you think the Indian markets, in some sense, maybe might much better placed, the Indian stock market in particular, than most other markets, given these emerging strong fundamentals and the delta and the change in these fundamentals from the last 5, 7, 10 years?
I don't feel like I know enough to give your viewers, Surjit, advice on whether to buy or sell the Indian market at current levels. I think there's enormous economic potential in India. I think India is challenged by the issues around making democracy work for people. I've had occasion to see data on absenteeism rates for teachers in Indian schools, and those absenteeism rates are very distressingly high for a country that wants to evolve to be a functioning modern state. I think there are challenges of reform of the basic way in which India provides services. I also think the large challenge for India is that there is one historical model of very rapid growth for developing countries, which is first you grow rice, then you make then you make textiles, then you make shirts, then you make bicycles, then you make motorcycles, then you make automobiles, then you make ships, then you make planes, and then you're rich. And that industrialization-based model, I think, is unlikely to be open to India over the next generation in the way that it was open to other countries in Asia during the last half century. And so the question of what is the growth model that sustains 8% growth or 10% growth for long periods of time, it seems to me looms very large for India.
Okay, this has been a very enriching conversation, and I think listeners and I have learned a lot, and I would really like to thank you for having participated in this, and look forward to more opportunities in the future.
I do too as well, Surjit. Thank you for the chance to be with you. Thank you for the chance to be with all your audience, all your colleagues. And I very much look forward to the opportunity to visit India again and the National Stock Exchange. Thank you very much.
Yeah, the host might have a few questions for us, etc., but I'm turning it over.
Well, unfortunately, I would love to ask Dr. Summers a few questions, but unfortunately, we've run out of time, Dr. Bhalla. But what a conversation between the both of you, spanning the growth versus inflation debate, to how it applies to climate change, to the tools that monetary policy makers now need to use to build resilience, of course, in the global economy, and from just in case and just in time, both being important elements, and summing up with what worries Dr. Summers when he looks into the crystal ball and looks at the global economy, see how it's emerging. Of course, market efficiency was also a factor in that conversation. As I mentioned, lots of insights coming in, and a great exchange of thoughts and ideas between Dr. Bhalla and Dr. Summers. Thank you, gentlemen. Thank you so much for joining us for this special presentation. But on that note, we'll wrap up this Dr. R.H. Patil Memorial Dialogue 2021 with this fantastic exchange of ideas that we have seen. Thank you so much for joining us for this special presentation.